Hey everyone, thanks for joining today's video. In today's video, I'm going to be talking about my 5 largest Canadian dividend stock holdings. In my dividend stock portfolio, I own both Canadian and US companies, but this video is going to be really focused on just my top 5 Canadian holdings. If you want to see more about my overall portfolio, I have other kind of portfolio update videos on my channel that you can check out. We're going to jump into these 5 names. We're going to talk a bit about why I hold each of them, a bit about the companies overall, their track record, some of their investor relations, slides, and whatnot. So we're just going to jump into number 1, Canadian National Railway. This is my largest Canadian dividend stock that I own. It's about 7 or 8% of my overall portfolio. And I've actually owned this stock for almost 10 years now. I think I picked it up in the mid 80s. So it was probably somewhere here in 2016 where I started buying in. And I've just consistently added every single year to this position. The stock's essentially doubled over the last 10 years, and I've also gotten some nice dividend growth. Right now, the yield is 2.1% starting, but I think that dividend's probably tripled in absolute terms. So maybe yielding something closer to 6% yield on cost or whatnot from what I bought 9 or 10 years ago. Company is worth about $100 billion today. And if we take a look longer term, you can see just how well this one's compounded over the last 20, 25 years from just $6, $7, $8 a share on an adjusted basis all the way up here to about $160. And it was actually about 175, but have dropped off a bit lately as they've revised their outlook downwards. So let's get into a couple of the reasons I really like this company. First of all, they have a great moat on the company. Just geographically, they go coast to coast in Canada, and then they go all the way down through the US as well. So lots of different lots of different businesses, whether that's agricultural businesses, automotive businesses that import or export off of the ports. They really don't have any other option than to use CN Rail. Lots of the cities that are on CN Rail's tracks, it's not CP Rail running parallel to them necessarily. So it's really only one game in town if they want to get their goods out of their region and to the rest of the markets and the big cities across North America. And no one else is building new rail lines. So they just have a great moat on their business. That's one thing I just want to highlight. No one's building any more railways like this across North America. And North America is obviously been the best economy in the world, and I think this is also a bet that that will probably continue. The next thing is they are naturally diversified just based off of all the different industries they support. You can get a bit of a sense here, the bottom left corner, but that's a great thing as well. They also have a bit of diversification in the different types of businesses they have within the business, whether that's West Coast import exporting, East Coast import exporting. Within both of those, they do continue to have opportunities as well for growth. Looking just a bit more on their revenue splits, they have a lot of businesses a lot of business in commodities. You see lots of chemicals, lots of forest products like lumber and whatnot, metals, minerals, etc. But they also do a lot of just movement of goods like intermodal and whatnot. So it's a good mix, and depending on what's going on with commodities, the price of oil, it's so many different puts and calls on their business that when one thing's going down, typically means other things are going up, and they can just adjust their capacity accordingly in terms of where they're running trains and how frequently and whatnot to move goods around the market. Now, in terms of some opportunities, stocks trading at around 18, 19, 20 times earnings. I think they're going to do about $7.50, $8 a share of earnings, and they're trading at about $160 a share, give or take. And in addition to just pricing with inflation or pricing above inflation, population growth, those kinds of things, they're also making really big investments and have highlighted big opportunities on how they're really going to accelerate growth moving forward. One of the big things they've been talking about over the last few years is just the available capacity on the east side of the network. The west side's a bit tighter in Vancouver and all the goods coming over from Asia and whatnot. But on the east side, you can just see here in the bottom corner, they have tons of unused capacity that they can build into and just create more demand for coming into these ports here and this network here on the east side of their network. In addition to that, they're looking at actually expanding Vancouver just to make sure as the opportunities there continue to grow that they're not going to be unable to capitalize on it because of the capacity being already full. So there's lots of huge joint investments between the government, CN Rail, etc., just to expand capacity on that port, which should bring a lot more volume and revenue into the network. And then just in terms of track record on this name, talked a bit about the dividend earlier, but you can see here, so 2015, 2016, dividend was about $1.50 a share. It's all the way up at $3.38 now. So the share price has doubled in the last 9 years, or 8-9 years. In addition to that, the dividend has more than doubled in the last 8-9 years. And this is one that kind of has continued to increase their dividend at a high single digit to low double digit rate every single year, year over year over year. Dividend increase every year since the 1995 IPO, and 15% cumulative annual growth rate. So we're not seeing those 15% as frequently over the last couple of years. You can see here 316 to 338 was the last one, so that's probably more like a 6-7%. The year before that was probably another 8-9% there. So the 15% and the very high growth ones may be behind us in terms of on a compounded average growth rate, but you're still getting some pretty nice growth. You can still take that dividend increase to the bank every year. In addition to that, they've been rebuying tons of shares on their business. You can see here $4 billion a year. That's like 4% of outstanding shares on their market cap. You can really see that visually here over the last 5 years, going from about 720 million shares down to 630 million. So they've really bought back, give or take, 14-15% of the company in the last 5 years. When I first started buying the company, I think it may have had over 800 million shares. So you can really see they've pretty much bought back 20-25% of the company since I started buying shares in the company, which is a great additional way to return capital to shareholders in addition to the buybacks, or in addition to the dividends rather. And then we were talking about the EPS a bit. Current year expected to do about $8 a share, so trading right around 20 times earnings, maybe slightly less. And then going from $8 to $9 a share, which would be a huge jump, about 15% EPS growth if they're able to pull that off. And if they're able to do that, then next year's earnings, the stock's trading closer to 17 and a half. So just given the moat that this business has, given their track record, the dividend growth rate they have, their commitment to buybacks, and just the position they have in the North American economy, I think 17 times forward earnings, 17, 18 times, is a really fair place to be picking up this name, especially, given the success I've had with it over the last 9-10 years. It's one that I'm going to continue to hold. Hopefully is organically going to grow into a bigger position, but also on sometimes little areas of weakness, I don't mind averaging into this one a bit more. Going into the second Canadian dividend stock that I own here. This is my second largest Canadian dividend stock in my portfolio. I think it's only 1 or 2% below CN Rail, so probably 6% give or take of the overall portfolio, and it is Riocan. Riocan is a commercial real estate company, operates in the major cities in Canada. You can see here it pays about a 5.5% dividend yield. These names have really struggled ever since the pandemic. You can see here in 2019, stock was actually riding high around $26-27 a share, quickly crashed into the low to mid-teens during the pandemic, bounced back a bit, but has really been settling in over the last year, 18 months, into this $16, $17, $18 price range, before very recently jumping up over $20 as the outlook of interest rates have really changed in the economy. And, the funds from operation, which is kind of like the proxy of EPS for a REIT and other like utilities and infrastructure companies, is going to be about $1.80 a share on this name. So it was trading at 9 to 10 times earnings per share, essentially. Now looks like it's trading close to 11 and a half times funds from operations. First of all, when I compare this to some of the large retail REITs in the US, think Realty Income and whatnot, they trade around 15 times even in this environment. So right there, you're getting about 25% relative discount. And it's a lot of cases to be made that say, Ryokan may actually be better positioned or may deserve a premium valuation versus some of the US peers. We'll get to that in a minute. But first of all, just wanted to look at, what are their tenant mix like? And the reality is, while some areas of retail and commercial real estate may be experiencing some headwinds or longer term headwinds, their portfolio here is really defensive. 20% grocery, pharmacy, liquor, 15% essential services, 12% value retailers, think TJX Group, think Dollarama, and then 10% experiential, going down to some other names here, 7.5% QSR restaurants, which is pretty defensive as well, 9% other essential. I think this includes like drug chains and stuff like that. So if you just start adding some of these up, you're getting to like 70, 75, 80% that are really e-commerce proof and really discretionary in nature. No matter what's happening with the economy, people are still going to be going to the grocery store. I don't think they're going to have any apocalyptic event on pharmacies and drugstores, and especially value retailers and whatnot. So I think their portfolio is really well positioned. They've been orchestrating it in that way for a number of years now. In addition to that, we're talking about just their FFO guidance. So I pinned it at $1.80. That's pretty much in line with what they're communicating here. And lastly, just on this name, there's lots of relative tailwinds versus the U.S. commercial real estate market. One of them is that in a handful of U.S. cities that lots of these REITs are in, the population growth is not equivalent to the growth in the large Canadian cities. The second thing is supply levels. I think the average square foot, commercial square foot per person in the US is like 40 or 50% higher than in Canada. And they're just not building shopping centers anymore or some of these commercial spaces in these major cities. So the supply per person is significantly lower, and the growth rate of that is not growing in terms of the absolute supply of lots of these centers. For every kind of retail square foot that goes up, there's more that's going down as they knock it down for condos or other developments or industrial or whatnot. So just the inventory they have puts them in a really good spot, especially with large national tenants. Going on to the third stock I own. This is the last Canadian dividend stock. Out of these 5, only 3 of them I have really big positions. So I'd say TD Bank, I'm probably at around 5% of my portfolio. The next 2, it's a pretty big drop off. But CN Rail, Riocan, TD Bank are really the 3 that I have pretty massive positions in my portfolio in. And this is one that, I've liked over the long term. It's performed really well over the long term, but over the last number of years, it has kind of stalled and stagnated, and we'll talk about that a bit. But TD Bank, great franchise. They have a very strong presence in the Canadian market. They've been growing in the U.S. over the last 5, 6, 7 years. They do have a stake in from their TD Ameritrade business when that merged with U.S. brokerages as well. And they have been selling that sometime, or they have been offloading some of the shares in that partnership. But nonetheless, pays a 4.7% dividend, trades around 10, 11 times earnings here. And historically, they've done a really good job of growing their dividend, which we'll look at in a second, but also just really growing their earnings per share at an impressive clip over the last, 10, 20 years. I'm talking longer term here. One of the things as we look back last 5 years here, which we see not very impressive results. You can see here the stock's at the same point it was May 21, so that's over 3 years ago. And honestly, that's actually being generous because the stock's really rallied 10% or so in the last month alone. So before that, the stock's really down on a 3 or 4 year. One of the main components of that has really been the issue that they've had with some regulatory concerns in the U.S. They got tied in a money laundering scheme out of China. They also had a lot of other issues in their U.S. division that got leaked out, or with whistleblowers and whatnot. Don't want to go into too many details. There was a lot of different levels of issues on the U.S. side of the business that got uncovered. They put a lot of money to the side to pay for fines for it. You see here $2.6 billion provision, which is a huge number for the bank. And this is just something the company's still digesting. It's going to slow down the U.S. growth. They're going to have a really hard time growing via acquisition in the U.S., which seemed like it was going to be part of the model as they really buffered up their capital position. But that clearly hasn't worked. In one example here, they did have a deal to acquire First Horizon Bank in the U.S. for about $13 billion. You know, there were a number of reasons why I think this one fell through. I think the most obvious one was regulatory. There was a lot of prominent U.S. senators saying, no, we don't want this deal to go through. TD Bank hasn't proven to be a good actor based off of, you know, recent events and whatnot. And that's one of the things. The second thing was this deal kind of fell apart during the regional bank crisis over the last year, where lots of those banks more on the west side of the country were going under and going bankrupt and getting scooped up for pennies. So it was kind of not the most attractive time to be buying into regional banks. And I think TD probably saw that and said, you know, over $13 billion, maybe the $200 million break fee may be worth it, especially with the regulatory road ahead. So I think it was a combination of both of those factors for the most part. But it really spells out an issue with the story on TD, because the U.S. Accelerated expansion was really what investors were looking for in terms of the growth. And now they're kind of in a mode of, yes, they still want to grow in the U.S., but they may have to do it more organically, which will be slower. They announced a share buyback after the First Horizon deal fell through. So kind of like still figuring out how to get through this, still need to settle some of those regulatory issues in terms of fines and getting that behind them. So the stock has been in a bit of a transition. They just announced their current CEO will be retiring over the next year and a new CEO coming in. Hopefully with that can kind of pave the way to you know, the next chapter of the bank's evolution. Just looking at results, though, continue to be pretty strong. I'm going to look at an adjusted basis just because there's so many provisions and whatnot going on with all of these issues. But revenue grew 8% year over year. Net income here we have as flat. They've had some other challenges. We just talked about some of it. Diluted EPS up 5%, which is nice. Return on equity 14%, not the best, down 40 basis points from last quarter, but up slightly from the last year here. You can see provision for credit loans up pretty significantly, 1.1 billion. Let's see, that was up about 300 million from last year. So that's probably one of the main reasons why we had net income growth come in so light despite decent revenue growth there. And lastly, I know we talked about this at the beginning, but the dividend per share here, really strong dividend growth rate, 10% annualized dividend growth rate over the last 25 years. Very similar story to CN Rail. I've held this one for around a decade here, so I've really realized great returns just on yield on cost from this dividend going up year over year over year. Give or take, my thoughts on Canadian banks longer term. They are essentially an oligopoly. They're in really strong positions in one of the best, you know, economies in the world. There's only 4 or 5 of them, and I don't think if anything serious happened that they would be allowed to go under or whatnot. So I genuinely think that the multiple of around 10 times that lots of these banks have been trading at is just too low, given, you know, the growth that they've had, the population growth that Canada is going to have, which is going to continue to force you know, users and dollars up here in terms of the revenue that they bring in. So they've just been in a position where they're yielding 10% cash flows, which they tend to pay about 40 to 50% back to investors via dividends, and you see that here. And then the other, you know, 50% of cash flows that they're generating, which for TD, I believe, is about $150 billion company, which means that that is around $7 billion a year, give or take. They can buy back shares, they can buy businesses like First Horizon, which they tried to do. They can invest in different capabilities. They can invest in new businesses, expanding wealth management in the US. It's just so many different things that they can do with all that money in addition to returning money to shareholders, given the fact that these stocks trade at 10 or 11 times earnings. If I compare their moats, their market positions, the attractiveness of their business versus lots of stocks that trade at 15 times multiples, 17 times multiples, usually I feel like the banks actually compare pretty well. I guess the only downside is in a recession, banks may be hit harder just as the consumer gets hit, especially like TD has a big commercial bank, so they interact directly with consumers a lot, lots of mortgages and personal lending and stuff like that. So that's kind of my devil's advocate. But overall, I think these banks will outperform longer term, even though they've kind of took a step back over the last couple years, especially on TD. In terms of EPS, despite all the headwinds, provision loans going up, regulatory provisions being put aside, stocks expecting to earn about $8 of EPS, so trading 10, 11 times this year's numbers, 8.38 next year, so about 10 and a half times next year after this recent rip in the stock. So once again, pretty fair multiple in my personal opinion, given what you're getting on these stocks and given the track record they have on dividends, buyback, total shareholder returns. Stock number 4, we're going to go through pretty quick, but it is Fortis. Fortis here in the last year is up about 13%, paying a nice 4% dividend as well. This is a utility company. They operate in Canada, but also in the US, so some geographical diversification over North America. They have done a really, really nice job increasing their dividend as well. So you see here, they're highlighting 50 years of dividend increases. They've been increasing at about 6% a year over the last number of years. I think last year, the year before, they reiterated over the next 5 years, they're hoping to continue that 4 to 6% increase. Oh, it says it right in front of my face, here to 2028. So I'm expecting this to get passed on like clockwork. They have really earned a lot of credibility with the street, and they tend to do what they say. They always hit their estimates within give or take 1 cent of EPS on a quarterly basis. It's a really boring stock to own. The one, not watch out, but just thing to consider is they do trade in line with bonds a lot. So as bond yields go up, lots of money kind of flows out of these investments into bonds. As bond yields go down, vice versa. And I think that's part of the reason why we're seeing this rally here over the last few months of 15% or so, just as, other yields in the market has gone down. They've been coming back to Fortis, which at the time was probably yielding close to 4.5% there. But over time, they have shown the ability to create pretty nice value for shareholders fundamentally, as you can see by the chart. So just that capital appreciation that they've kind of been proven to execute on, plus the 4% dividend yield that grows every year, I think it's a good boring stock to hold as a Canadian investor. And moving to my 5th stock, and like I said, the top 3 are really the bigger positions here. I think A&W may be about 2.5% of my portfolio. Looking at this one over the last 5 years here, it's been a bit of a wild ride. Before the pandemic was up at $37 a share, kind of traded down into the low 30s, went back up to over 40 in March of 22, and then actually went down into the 20s until recently. A&W announced that they're planning on merging the royalty company with the actual restaurant corp and but at the price of $37 a share that is supposed to go into effect this October. So we're going to talk about that for a minute. But at current, the current stock rather is just the royalty fund. I think they get 3-4% of top line revenue from all of the locations in exchange for trademark rights. That equates to 5.5% that gets paid monthly on the current share price here. So let's take a look at this stock a bit. A&W, the QSR restaurant of A&W operates over 1,000 stores in Canada, almost all franchised. They're the second largest burger chain in Canada, obviously behind McDonald's being the number one, but that makes them the number one kind of local burger chain in Canada. They've had decades of sales growth, which we're about to look at in a minute, and they do also have some white space opportunity, which we're going to look at too. Looking at where they operate, they are very heavy on the west side of the country. You can see here about 390 locations just between the two far west provinces here. Also a nice presence in Ontario, but it really drops off once you start going right of Ontario to the east coast. In terms of the mix of restaurants, 600 drive-thrus. One thing I've noticed from owning the stock over the last number of years is their food court number continues to go down. Not sure if it's just with the pandemic, lots of those businesses went out of business, as lots of them are franchise owned. Maybe they just shut their doors. But the urban street front's been really where the growth's been coming from. This number has gone from pretty much 0 to over 100 over the last number of years. These are smaller downtown locations in probably more cities like Toronto, Montreal, Vancouver, stuff like that. So those are a good mix to add in, just as those populations around those cities continue to get more and more dense. And just on a unit economic or per square foot basis, I assume these are pretty darn productive for the company, and probably more strategic than food courts and whatnot going forward. Okay, this kind of looks at their overall sales history. So you can see here their growth from 2003 on revenue has been about 300%. That's outpaced the broader quick service restaurants in Canada really nicely. So they're just showing all the share that they've kind of garnered over that time period when you kind of put it all together over decades and decades. And then this is one of the interesting white space callouts they make. So they're comparing themselves versus McDonald's, saying, hey, the west side of the country, we're essentially at par with them. But the east side, we have huge deltas of almost 400 restaurants. Now, it's not that easy to just close that gap, open 400 restaurants. There could be market differences, consumer differences, heritage differences, whatever. But it does kind of go to show that they do probably have an opportunity on this side of the country to potentially at least attempt to close that gap versus McDonald's, since they've been successful in playing with them at parity on the west side of the province. And why does it matter if you're just getting a royalty fund? And with new restaurants, it tends to dilute the overall share count of the royalty fund. So why does it matter that they have this huge opportunity to open all these new restaurants if you don't actually own the franchises? Well, that's one of the reasons they're trying to just align the objectives of the overall company here. I think they're also trying to take advantage of a bit of a battered down royalty stock price. If you look at the multiple, used to trade closer to 20, 25 times, now trades more like a mid-teens. And they look at other QSR stocks like McDonald's, Yum Brands, Wendy's, whatnot, and they tend to trade in the 20s as well. So I think they're trying to close that value gap that they're seeing on their business by bringing in the whole company together. You can kind of see here some of the specifics. They're planning on offering $37 a share, which you're seeing here in cash or common shares. So the stock right now is trading at about $34.60 a share. So almost 10%, 7-8% of upside between now and October, just if this deal closes and you opt to sell your shares for $37 to the company, as long as I'm understanding that agreement correctly. In addition to that, you're getting paid 5.5% paid out on a monthly basis, just to wait for that to take place. Now, I know I'm filming this in September now, but this was also true 2, 3, 4 months ago, where that was the arbitrage opportunity in addition to getting the yield to wait. They kind of map out how they plan on supporting the business in terms of leverage and whatnot. And in addition to that, they've kind of promised that the yield of, I think it's 16 cents a share per month, so equates to 5.5% a year, will also remain the same under the new structure in terms of the absolute dollars being paid out in dividends, just trying to kind of attract that high dividend investor who was attracted to the royalty fund for those purposes. You don't need to sell your shares. You can continue to own the overall company and kind of take part in the broader growth opportunity is kind of the sell, let's call it. So I'm planning on probably holding at least for a bit, listen to, a year of earnings calls, see how it's going, take a look at the combined results companies results and whatnot, and we'll see how it goes. It's one that I'm excited to kind of see come to fruition. Hopefully the stock price actually ends up going to $37 and above once the deal kind of gets finalized and moves forward from there. But this is one that I'm planning on holding within my top 5 here. So I hope you guys liked this video. If you did, let me know in the comments which out of these 5 stocks you own or you're looking at or you're considering buying. And if you like this kind of content, be sure to give this video a big thumbs up. Consider subscribing to the channel as well, and I'll see you guys in the next one. Thanks.